All right, we are live. Hello, guys. How are you?
Hey guys, hey Sylvia. Glad to be here. I'm loving life on a Thursday morning at 12 a.m. as usual. So, how are you, Brian? How's things going your end?
Good. Yeah, middle of a Wednesday for me, and yeah, always good to just come together and chat with you guys, see what's going on.
Fantastic. And John, it's early morning for you. I think it's what is it like 9
Oh, it's
a.m. 10
neat. It's 9 a.m. That's neat. That's a normal day for me. I'm usually up at like 7, so 6. So it's an easy day. Yeah.
That's cool. Well, hello, everyone, and hello, everyone who is joining us on this week's fireside chat. Today, my name is Sylvia, aka Crypto Empress. I am here today to help you get your questions answered and to delegate the fireside chat. If you have any questions during the presentation of the speakers, you can write them to the stream chat and I'll forward them to our speakers. Let's welcome Jonathan Libby, Akash Mahendra, and Brian McCabe to our this week's fireside chat, where we talk about DeFi hacks and how history repeats itself. And what can we do about that? History obviously repeats itself because with a new week become new DeFi hacks. Hong Kong cryptocurrency exchange Bilaxy was the victim of a hack that compromised a hot wallet on its platform on Sunday. What do you think, guys? How many millions of dollars got stolen this time? Tell me your wild guess.
I don't want to think about it. It's like, oh God. Well, all these hacks, I think often the range for these hacks is between 18 and 25 million. So if you always want to get a guess, it's always kind of between that range right there. There are some outliers, such as within the standard deviation bell curve, whether it's the 600 million poly market or the 600,000 hack that just happened recently as well. But often those range between hacks is between 18, 25, 30 million. If you can get coverage like that, you can cover 95 to 98% of events.
That is correct. Yeah. Yep. You wanted to say something? Yeah.
I was just going to say another day, another hack, but as you sort of like read into the complexity, and I mean, some of these just seem like kind of a genuine human error or some like coding bug, and I guess we can start to go into like what is really like the core of these, what causes them. But there's so much complexity when it comes to like multiple chains. Now you have so many chains that are connecting to each other. You have pools of liquidity to supply each of them. Like as DeFi keeps growing, complexity keeps growing, and a complex system is going to always be a little bit weaker at some point. And it's like, I guess it's a topic even to think like, are we getting too much layers upon layers upon layers upon layers where eventually something can break and this can cause an exploit across one or multiple. But yeah, it's another day, another hack. I don't know, is this like 15 or 20 last month, but a lot of money lost, unfortunately.
Yeah, and the thing is with this is another centralized exchange. I think last week it was Liquid exchange in Japan. So even centralized entities aren't safe, which is what people trust in this CeFi DeFi world. You assume that if your money is in a centralized exchange, one which has been running for a long time, your money is safe. But that just doesn't seem to be the case anymore. So it is interesting. It is a cryptocurrency, which is in the blockchain industry, which is very new. So yeah, early days, I suppose. But I hope that Sylvia, that one day we can look back at this and back at this time when there's a lot of hacks in the future, when we are in a much safer place, and it have a bit of laughter, I suppose, and how what a wild west it was.
Definitely, I agree. And as you said, Jonathan, around 20 million is correct indeed, because there was confirmed 22 million. However, some indications in Telegram actually say that the whole stolen amount could be somewhere around 400 million as well. So that is yet to see. And yes, the Bilaxy hack was the 20th DeFi hack I would say this month, but now we have already September. So in August, we have 20 DeFi hacks per month. So I think that is like truly insane. But did you guys hear about the Cream Finance hack that happened on Monday?
Heck yeah, we did. I think that was also 18.8 million. I think was the amount of that hack. I think
that wasn't even the first time.
No, it wasn't. No, I think what we're going to start seeing is a lot of industry demand for protocol insurance, and I think this is, Cream is, we've already started early conversations to advise the Cream. There's already a lot of market interest in, I've noticed, I've had multiple people message me, we're like, have you heard of Steady State? I'm like, heard about it this week. We're looking into it. A lot of different groups like these guys have been messaging me. I remember I heard from one guy from Polymarket, a week ago. He reached out to me and said, "Hey, you hear about Steady State?" And he's like, "Oh yeah, we're doing research in Steady State now." And the Cream, I've heard that as well, and a lot of those different groups are starting to keep the conversation going because there's starting to be an understanding here where they have some pretty amazing engineers and developers, but I think in theory it's still code and there's some still fallibilities in the early models, just like the internet. We, like Cash said, we're in the Wild West. There's a lot of phishing attacks, a lot of different, people are very exposed to a lot of different risks when they first use the internet. And it's gotten very controlled over time. And that's what's going to happen here. And so I think what's really important right now is, we start covering these catastrophe risks that people are exposed to, whether in Cream, whether in Polymarket or any of the protocols, and making sure we have a good scalable model to keep doing that well. And so very excited to having the Cream, and excited to hear that people are talking about us. So
yeah, and guys, I think not sure if you guys follow the news or those Twitter feeds often, but as of 2 days ago, we have the highest TVL and ETH ever. So I think it's 90 billion or so. That's the highest it's ever been, reaching surpassing the recent, I think it was May or June high. I think the May high, the previous run went up. So, it's the amount of money which is locked in Ethereum is equivalent to a top 20 bank in America. Now, I mean, why doesn't that kind of, platform which has so much money in it not have proper insurance for its companies which build on it, which is essentially the protocols? So if you use that analogy that Ethereum, you just put your funds in the bank, but it just needs insurance, and it's just still not there. Still too many hacks. I think you really got to treat it like how much money is in the system, and really got to think how can we fix the errors right now. And that's why we're here, Sylvia. And it's interesting that if you compare it to a normal sort of the amount of money a normal bank has compared to what the TVL on Ethereum.
Yes, I definitely agree, because this is very true, because unlike regular bank accounts, which typically offer fraud protection to ensure lost or stolen funds up to a certain amount, exchanging cryptocurrencies isn't regulated and hence is uninsured. And due to this, cryptocurrency theft is one of the fastest growing cyber crimes. So from one point of view, crypto and DeFi are like wild west at the moment, giving us bigger gains and loss of opportunities. High risk equals high reward. However, without no regulation and insurance, it brings scams and exploits with poor solutions. What do you think, guys, about the hacks and exploits effect on DeFi image, where DeFi could have been versus where it is now?
Well, if I just quickly say something at the start, I think we are in a very new space here, and we have a lot of great engineers. Some of the best brains in the world are working in this space. Of course, all the best brains in the world haven't solved how to best solve for what could be crime, what could be malice, and what could also be just honest mistakes which can be coded in. And I think communities are still to reach a consensus on how to deal with this problem. As Akash said, we have banks the size of Ethereum, but we all know major banks, Wells Fargo, I think there was quite a few stories of major hacks and major funds being lost from blue chip US banks, but very often this doesn't come out in the public because they don't have to make it public. I mean, banks are essentially a private ledger, and if it's not advantageous for them to reveal that they were hacked, then very often they choose not to. So we also have to admit we're living in a world of extreme clarity, I guess you could say, in terms of crypto. If something happens on the blockchain, everyone sees it. We also have the ability for everyone to audit what's there. I guess right now, personally, I think there's like the balance of like risk reward is maybe a bit more in favor of, okay, I can take advantage of this exploit. So like maybe we just need to tip the scales of justice back a bit, encourage maybe more bug bounties, reasons for people to actually come forward. I mean, we don't know what happened with some of these hacks, but very often when the hacker realized they didn't do it right, they suddenly were penetration testing. So like maybe there's insurance is a part of this strengthening between ecosystem projects, but yeah, I think ultimately the balance of risk and reward is still a little bit on, okay, this exploit is worth a lot and I should take advantage of it. And the talk we need to have in DeFi and crypto is like, how do we balance the scales on this? Is my thought.
I guess to kind of go what you said about where we'd be without hacks. That's kind of a tough question, because if you say take all the forward progress you've had without hacks, well, there's a lot of unknown there. You know, people don't want to try new things, or they're afraid to try new things. So when you see, just because the hacks haven't happened, the risk can still be there. And so when it comes to people asking about trying new things, you know, it took a long time for people to evolve and move from telecommunications to the internet. And with the value add still be there. Hacks in some way have been really valuable, in my opinion, because we're being exposed to, we're understanding a lot of the risks we can start considering as we keep evolving and moving into this decentralized network, where we start sitting, especially these layer ones, layer twos, different kinds of nodes. Where we would be is unknown. Where we are, we can see the values come from it. But where we would be, say, without the hacks at all, I mean, people would still be thinking about it. There would still be FUD. There would still be all these narratives and noise. And if it was a perfect system, again, I don't know if we'd attract the same attention. It's imperfect systems that have the most value, because often imperfect systems are brand new, they're untested, and they're untried. That's kind of where I think we'd actually be. If you ask where we'd be, where we wouldn't be, is I actually think hacks have helped us evolve quicker. It makes us challenge. It makes us take on challenges. It makes us challenge how numbers work. And when there aren't new challenges, we get bored. And when we get bored, we don't want to evolve. So I think actually where we'd be, I think hacks have actually put us in a better place, in a worse place long term, because it's pushing us to keep pushing the ledger, to keep growing, to keep evolving. But without them, it's very uncertain for me to see even where DeFi would be if we even gotten this far. And that's probably an odd answer you wouldn't have expected, where you think, oh yeah, it'd be way, way, way farther. But there's a reality about human nature to take in and how we evolve, and we want challenges. And these hacks and these known risks that we're constantly trying to fight make it so we want to evolve more quickly.
No, I generally agree. I think what John said is true, because these kind of issues are really bootstrapped innovation in a way, because you know, obviously DeFi is all about innovation, which in broad terms aims to replace the existing financial structures with you know, systems which are more accessible to the average person, especially in third world countries, people who don't have access to the same sort of you know, banking infrastructure and the systems that the Western countries do. Now, one of the things what John said was, you know, this kind of helped growth, which is in a way actually really, really solid and true, because I'll give you a good example. So back in the Uniswap casino days, that was September 2020, when, you know, people first started using Uniswap. You know, it was you buy a coin, go to sleep, and it's like somehow 10 or 100x overnight kind of thing. Everyone started doing rug pulls then. So that was like when the rug pull thing really properly started, because you put liquidity in Uniswap, and like 2 days later you take liquidity off, and the person who does that made a lot of money. That made people, you know, a lot of people started making liquidity lockup tools and liquidity lockup apps, like Team Finance is a great one. So now if liquidity is not locked, no one kind of buys that coin generally, because that's just, or you burn the keys to the liquidity, you lock your funds in Team Finance for I don't know, God, like 6 months, a year, however long you want to lock liquidity. So in that way, that really did bootstrap and bring forward the whole liquidity lock thing. The rug pulls, brought it forward. Otherwise, I'm sure it would have come eventually, but it would have come maybe 6 to 12 months later when the DeFi was further down the line. So all these issues have eventually, I think, brought fast forward growth more than what we realize actually.
I definitely agree with what Jonathan was saying, because I think I read about one person who got hacked, or investor, and he pointed out that or justified that saying that if a code of a smart contract allows someone to take money out, then they're allowed to take money out. So basically that if you have a project that is not secured enough and a hacker gets the money, then it's a sign that you should work on the security of this project. But let's say in that case, when the hack happens, do protocols have reserves in case of hacks, or how big these reserves are, or if they don't have one, then why so? Can you?
Yeah, every protocol has a reserve. It's called the treasury. So every protocol has a treasury. The treasury is used to cover, the downside risk of those events that they're involved with in the system. The treasury code is often different and has different levels of risk than the smart contract code on all these different liquidity pools or other things they provide. So with these treasuries, you have to ask yourself, okay, you have to pay a lot of fees. Administrative, you have to make sure your tokens are covering the right value. You have to make sure that you're covering a lot of costs, and hacks can be very disruptive in covering those costs. And so when you think about a treasury, okay, the treasury, these guys, as they keep scaling and growing, they need to figure out, how do we take the growth of our total value in our treasury and how do we actually grow it much larger? And that's something they got to start thinking. Businesses are thinking about this all the time. It's a very dynamic concept. What we'll do, what will happen is they need to have a portion of the treasury just dedicated to covering downside risk exposure. And the problem is, say you have a $60 million fund, you're dedicating 10%, $6 million to cover the downside exposure, but you have, say, 50 million in industry, into the value, probably 100 million in the value of the system. Remember, we said we need a 20-30% of the portfolio to cover that actually downside risk exposure. What you can do then, and this is where the dynamics come in about how businesses must evolve, is businesses take a portion of their value and put money down in premiums to maximize risk exposure. What if you could turn that 6 million into 10 times the value? And what that means is, say you're willing to pay a 10% say a group like Aave is willing to pay a 10% rate of return in Aave tokens for people willing to buy the risk of Aave. They take $6 million worth of Aave, and they are now changed that into $60 million of risk coverage. And that's what's going to happen with these treasuries, is they have to start breaking them down in values. How can we take this and grow it over an extended period of time? And that's what's going to end up happening in these models and systems as they evolve. Treasuries are used currently to cover downside risk exposure, but they're not going to be the long-term scalable model. What they're going to need is to take a value of the portion of the treasury, dedicate to a certain, whatever kind of role it needs to be dedicated, and then find ways to extrapolate the value exponentially. Steady state allows that model to happen naturally, where you pay a premium to get the stake value and coverage for whatever you want. So if you're willing to pay the 10% rate return Aave tokens, you can turn that $6 million of value over a year-long period into $60 million of maximum coverage necessary. And that's what the model is going to start evolving to. The treasuries now cover the system, but eventually we got to really interact more, just like business models do, just like this decentralized code is going to be eventually working together to extrapolate the value of the whole system of each protocol, extrapolate the level of protection and the value of the treasury dramatically for the good of their community.
Yeah, and just adding on to that, it's not going to be possible for projects such as, say, Thorchain, which had a few hacks recently. They want to grow to like above 100 billion, TVL just by themselves in a few years' time, or maybe earlier than that. But you can't expect them to have $10 billion just lying around, 10%, well, 20%, $20 billion, whatever it is, lying around, not inefficiently, and just having it there in case of a hack. So that's a short. Having a treasury is a great short-term solution. I think even Thorchain themselves recognize this, and recently after their hacks, they put out a press release saying that they want to implement protocol level coverage to fully protect their users from any possible attacks. So Look, having a treasury is great, I think, but what SteadyState is doing is bringing better and more efficient coverage, which is customizable to each protocol, so they don't need to have this rainy day hack insurance exploited treasury. So I think it's up to each protocol how they want to change their outlook on how the market should work. Even after, when there's protocol coverage available, they can choose to have treasuries. But I'm hoping that we can change that mindset to just seeking insurance in general.
Yeah, just adding on to like original point you kind of said there, Sylvia, about sometimes people can consider like a smart contract hack as a legitimate, I guess you could say, like money exploit, and this would be it would be seen ethical because the exploit was there to be used. That's why it was built. And like, I think something which even we want to start, even like, and protocols should even start asking themselves is like, if you do have a smart contract exploit, how do you look at this? Do you consider that this is like ethical and that the hacker should keep the funds, or do you figure that this is what a treasury is for, as John said? Because if I invest in a project, some people have very opposing views on whether like Tether will freeze funds, for example, in the case of hack. That's their policy, and they're very much like, everyone is aware that this is how they work. So maybe not so much point to steal Tether, right? So there is like potentially a benefit for them to declaring how they operate. I think if more protocols were to sort of state their intentions if something was to happen, and how they see ideologically these two different battles, you could say, that happen in crypto, and be on one side of it in advance, I think it's something good the protocols could do. And I think it's something as SteadyState, if we're making policies for people, we would want to ask them too, like, hey, so how do you guys see hacks? Do you think that this is an ethical thing, or do you think it's something which treasury is for and that you need to seek insurance for?
I really like that idea, that asking from people, like, what do you think about it, and is it ethical, and so on.
Yeah, I mean, right now most protocols say after they get hacked how they feel about it, which is maybe not the right way to go.
Exactly. But moving on, less than 1% of assets currently locked by smart contracts are held by insurance platforms. This is a source of discomfort for market participants and discourages adoption by retail investors. How will retail investors protect and profit themselves with SteadyState?
So with the 1%, I think the reason why is all insurance has been focused on retail. Something we all value being in the space, whether we realize it or not, is individual sovereignty. At its core, cryptocurrency, no matter what your beliefs are, how you express that beliefs, we have a core understanding that individual sovereignty is key to long-term, like I said, the next step of human sovereignty, or our ability to be the best versions of ourselves. And so I think with individual sovereignty, often we take the view that like you have to cover your own risks. And that's kind of what we got with retail insurance. And I think that view and that model often maybe has become inhibiting from helping us evolve and realizing communities can take care of communities. And that's kind of what the protocol insurance is trying to look like. What protocol we're doing is, for SteadyState, you use all these protocols. Sorry, you use all these protocols. Use Curve. Okay, you use all these different things. If you put $1 million in Curve, you could wake up tomorrow and that money's gone in Curve, and that's just a scary reality we all have to deal with. Now, it doesn't stop me from using Curve. I think it's still a great system. But if there was an opportunity for you to say buy the downside risk Curve, so if an event happens, you're profiting off that arbitrage risk. If something happens on the risk curve and a payout's needed, you could arb yourself, create an arbitrage where you're receiving the profits on the upside curve, but the money, you lose the money. Your actual own money goes in and re-implements the curve. And if it's neutral in the sense where these cat events doesn't happen, you're profiting on one end and profiting on the other. So, and then if one goes down, the other can actually cover the other. So like there's going to be some really interesting opportunities here to actually arbitrage and create different models of coverage for yourself. I think another way people will be able to profit off our model is because you're not because you're not getting insurance, rather you're covering the insurance as a protocol, you're going to be paid a premium. The goal of premiums is to keep them very low for the insurer and very low for the insured and very high for the insurer. And so these dynamics are constantly on a tug and pull between each other. It's a little different where the same concept applies to business insurance, but instead the premiums for business insurance are naturally higher, and these protocols have the premiums or the capital available to pay higher premiums. So what this means is stakers are more incentivized, but we're still going to have the highest premiums you can receive on a lot of these blue chip tokens that you can't get in any other system. And because of that, they will naturally, it'll be more of an attractive model for staking. So not only can you arbitrage yourself, this can be one of the best ways to naturally accumulate a lot of blue chip DeFi tokens. As models evolve and change from natural startups to progressing, growing businesses, often their tokenomics evolve and change, and it's harder to accumulate as a lot of these tokens naturally. Say Aave, if you can naturally hedge and accumulate 100 tokens or 50 tokens naturally, and not to think about it and make it passive, that'll be the future of how models evolve and grow. And that's kind of what we're doing with steady state is we turn the risk into profit-making opportunities.
I love this turning risks into profit. That sounds really good. But if you talk about institutional investors, for example, liquid insurance markets will accelerate DeFi's growth and promote its adoption by institutional players who require capital-efficient solutions for risk management. How will institutional investors be protected and profit themselves with steady state?
So, I mean, Sylvia, I can start off here. Institutions won't invest until they're properly protected. So, for example, not just institutions, but also saying hedge funds and other traditional finance, venture capitalists, mainstream banks, whoever, they're not going to jump into DeFi until they know that they have sort of a secure way to exit, but also their funds secure the entire time as well. So they need to have some sort of a sense of security that they're not going to get hacked, because they are playing around with funds which are not their own. So, I mean, the whole point is, I think John touched on this earlier as well, like if steady state covers the entire protocol, and if we show that the model can be trusted, the model works, the entire platform and protocol of the steady state itself is reliable, then that should give the confidence to institutions, hedge funds, venture capitalists to put money in DeFi, especially especially with the protocols that we give a high like a low risk rating to, and that's what we're trying to change here as well. We're trying to ensure that there's a way that everyone's money can be protected, and there's less downside risk for if a protocol gets hacked. So we're really trying to change the narrative on how DeFi is viewed by traditional finance and these institutions as you are referring to.
I definitely agree with this security part, because even from example, looking at mainstream media, crypto is still, or even DeFi is labeled as like very risky market, very new. So I think the security is definitely something that institutional investors are looking for, and is something that I think will bring them more into this space overall. All right. Do you guys want to add anything, or we will look what our viewers have asked us today as well? Let's see. We have Joseph Smith, who asks, how are we going to build long-term wealth without insurance?
Yeah, I mean, how are you going to build long-term wealth? I mean, I think when you think about long-term wealth, I think you're talking about the looming risk of losing it all to do some kind of randomized event that feels like you're out of control of. That's tough. How are you going to? And you're going to, but you're always at risk as long as your market's in the ecosystem, your money's in the ecosystem, that you're going to lose some portion of your gains. And so, yeah, you're going to get some kind of a return, but is the return going to be? Is the return going to be, let's say, what the value you want to receive? Is it going to be, or not the returns? Is it going to be you're going to be able to keep them? And that's where insurance comes in. It's insurance for protocols. When this steps in, is where the investor's scared of is if these systems you're using get hacked or lose a portion of their value, are the one affected. And I think insurance helps to grow the narrative that there's protection, that you're safe, and be able to see how much coverage is to the protocol, be able to actually understand demonstrably what you actually need for the level of coverage. It's not, and we always have that benchmark at 20-30% of the value. You can get there, you can cover massive amounts of the risks that protocols are exposed to and make sure you're taken care of as well. I think, you're always going to be making money with or without insurance, let's say, as a retailer. The question is, your risk is always there still.
Yeah, just to add on, I think like a lot of what John said is good. And when it comes to long-term wealth management, I mean, diversification is always key, that you're not always exposed to one particular risk or one particular black flag or black swan. And Steady State offers a very good platform for that. So like if you're staking on our platform and providing coverage, you're going to be getting payouts in like 10, 20, maybe 30 different protocol tokens, which could be part of one of our index pools. So, I mean, by default, Steady State provides diversification. So like up to some level, you're as a risk, we're essentially a risk management platform in a way ourselves. But someone made a pretty good comparison, which I'm still trying to work through my head now, which was like comparing us to a prenup. And it's an interesting marketing term, but I'm like, okay, so Steady State can be like a prenup between protocols and communities, or like we're setting, if it goes wrong, if everything goes bad, here's what you'll get. Like, so it's working its way around my head, but it could be an interesting marketing take.
I love it. It's very relatable, and I also like the saying, well, like, don't keep your eggs all in one basket. So diversification is also very relevant and true. And we also had another question from Trading Knowledge, who asked, could you possibly mint an X project risk into an NFT and then fractionalize it?
Yes, interesting question. I mean, we're kind of going to be doing that naturally. That sounds like what you do with a lot of different financial products. As you slice and dice, you move things around, and you create different offerages based on that. So when it comes to fractionalizing like an NFT, you have one NFT and then you break it down to a portion, of holders. I guess we'll be doing that as well, but the holders can opt into how much they want to hold based on the pool. Sometimes you have the option with the NFT fractionalization. I think sometimes you don't. So I mean, I guess for applying a lot of those concepts, and I wouldn't necessarily compare it to the NFT. I think that's an interesting way to put it, and it's not necessarily wrong. It's very unique, and yeah, that's all I can really say.
Yeah, just following up from John, I personally, and maybe Trading Knowledge can follow up with the follow-up comment. Why would you want to go through that route to spread your risk? Like, I mean, if you're just trying to spread your risk, because essentially if you want to create an NFT and fractionalize it, that means you want to spread your risk. Can't you just spread your risk from the initial, the collateral or the initial token, the PL tokens you have? Like, I mean, NFTs are cool, don't get me wrong, and there's a couple of great companies like NFTFY fractionalizing these things, but that's more for like, if you have something like a CryptoPunk and you want to use 1/10 of that as a collateral on a borrowing and lending platform, so you can actually use your NFTs to do something useful. But I don't really, I don't know if the person Trading Knowledge has commented on that, but what's the benefit of fractionalizing or going through that route? But yeah, maybe it's next week's show.
I understand someone found a question we can't answer.
Yeah,
but just to take on this, like, I mean, I've always thought of NFT as non-fungible, and when I think non-fungible, I think you don't break it down. It's meant to be one and done. And I think we have other mechanisms, pools like protocol tokens, and we have ways which can be done better.
That's great. And I agree with you, Brian, on this one. But as I see, we have no more questions here from our viewers as well. So many thanks to you, Akash, Jonathan, and Brian for joining us today. Yay, great discussion. We had great job. And thank you all who joined us as well and who tuned in. Make sure you check out the Steady States mailing list. It is finally up, and we'll be using it as another way to reach out to our community. So if you have not signed up, make sure to do so on Steady State's website. And
thanks,
see you all next week.
Everyone should join our Discord. We've just recently started our community Discord. We're building it. So, if you want to be involved in the early stages of building it with us, because we're open to ideas, this is a great time. We're going to have stickers, NFTs. We're going to have some memes on there soon. So, and we're just on the ground floor of our Discord. And if you want to help out or get involved, message our community person, Carl, on Telegram, and he'll hit you up with an invite link. Thanks, guys.
Yeah, thanks everyone.
Take care. Bye.
Bye.